Welcome to part 2 of this two-part video series about reversal patterns. Hi, I am Mahmoud Alkudsi, alias as Senior Market Strategist. In part 1, we discussed various types of reversal patterns and the essential conditions for their application. We covered the head and shoulders and the inverted head and shoulders patterns along with trading strategies for each. You can find part 1 at the top of the screen. In part 2, we'll delve into the remaining technical reversal patterns, the double top, the double bottom, and triple top, and the triple bottom patterns. Let's start with the double top pattern. This pattern is considered bearish as it shows how potential price declines if conditions are met, while the price forms two consecutive peaks. Once you notice this formation, it is essential to draw the neckline extending from the rebound after the first peak to the formation of the second peak. How do I trade using the double top pattern? Trading the double top pattern involves measuring the distance from the first peak down to the neckline and then applying the same distance below the neckline to determine the potential price target for the pattern. To enter the market, you could place a sell trade after the price breaks below the neckline. You should also remember to place a stop loss order above the neckline for the risk management. Sometimes the price breaks below the neckline and before reaching its target, reverses its direction and trades higher. Nonetheless, it is important to note that as long as the price remains below the neckline, the double top pattern is considered valid for application. So, once the price rebounds from this line and resumes its fall, it is possible to place a sell trade in case you missed the first sell trade opportunity when the price broke below the neckline. And this is an example of the double top pattern. The same terms and conditions of double top pattern apply to the triple top pattern. The only difference is the number of tops and everything else remains the same. And here an example of the triple top pattern. The double bottom pattern. This pattern is regarded as a bullish model because it shows a potential price increase if its conditions are met and characterized by the price forming two consecutive bottoms. Once you spot this formation, it is important to draw the neckline, extending from the bounce after the first bottom to the formation of the second bottom. How do I trade using the double bottom pattern? You can trade using this pattern by measuring the distance from the first bottom to the neckline and then applying the same distance from the top of neckline to determine the potential price target for the pattern. To enter the market, you could place a buy trade after the price reaches the neckline while placing a stop loss order below the neckline level for risk management. Sometimes the price breaks above the neckline and before reaching its target, it reverses its direction and trades lower. Nonetheless, it is important to note that as long as the price remains above the neckline, the double bottom pattern is considered valid for application. So, once the price rebounds from this line and resumes its rally, it is possible to place a buy trade in case you missed the first buy opportunity when the price first broke above the neckline level. And here an example of the double bottom pattern. The same terms and conditions of the double bottom models also apply for the triple bottom model. The only difference is the number of bottoms. And here an example for the triple bottom pattern. Well, that's all for this video. Don't forget to watch part 1 if you haven't already. Thank you for watching and I'll see you in the next video where we'll continue to learn about different aspects of trading.